most of the time when we interact with investors, the select funds is returns. In fact, most of them would say that, that's the most important criteria. So do you think should it be this way, or what's your view on using past returns as a good selection criteria?
So Sumana, it's a double-edged sword. I'll be very honest. And there's been a proliferation of a lot of DIY apps and a lot of these websites which publish returns frequently nowadays. Information is good, but I do believe that there's something known as information overload. In fact, it's a well-documented behavioral bias. You're a financial wellness coach. You're probably exposed to it all the time. What I've seen, at least what we've observed, is past returns are a very myopic way of evaluating a fund. So what most people I know do, especially the first timers, is they'll go to one of these apps or these websites and they'll sort quickly by 1 year, 2 year return, and they'll be enamored by it. Oh, wow, XYZ fund is given a 70% or an 80% return. And simply because they don't understand how securities markets work, they end up burning their fingers very, very drastically, because as you very well know, what goes up comes down. Everything moves in waves. Everything is cyclical, and ultimately, past returns are a lagging indicator. So are star ratings, by the way. So star ratings are all based on metrics that have already happened. So it's like saying that something has gone up in price, so let me buy a lot more of it, right? Which is exactly the opposite of what should be done. And this, unfortunately, over the last couple of years has created a bitter experience for a lot of first-timers. While equities are such a fabulous wealth creation tool, right? We know that it's outperformed pretty much every other asset class over the long term, real estate included. If you go and if you just sort by past returns, and if you invest, what's going to happen is you're going to keep making losses and keep making losses. And at some point, you're just going to throw in the towel, right? There are so many examples, Sumana. Few of them come to mind. I remember in 2017, there was a massive rally in small caps. And as it so happens, when the smart money exits, it is the retail money that comes in. And that's the reason, because they're seeing everything through the lens of 1 year and 2 year returns. And all of a sudden they see, wow, 100% 1 year return must be fabulous, right? And then what ends up happening is you very quickly fall by 40, 50%. And the same thing happened in 2021. Post-COVID, small caps shot up, they rocketed ahead, only to correct very drastically. I've seen this happening, especially in sectoral funds, Sumana, and thematic funds. I know pharma went up a couple of years back, and it's when it went up drastically that it attracted a lot of retail money. Look at US tech. US tech shot up during the post-COVID phase, and a lot of these tech funds were launched, a lot of retail money went in, all based on past returns. Wow, the NASDAQ has given a 50% return, must be fabulous time to get in. Except they don't understand it's probably the worst time to get in, right? And now the NASDAQ has fallen 30, 40 odd percent and is duly correcting. So what happens, Sumana, is if you base your entire investing framework on the myopic past return lens, you will constantly keep burning your fingers. And there'll be a time when you'll write mutual funds off as an investing tool, while actually the winners in the equity investing game are the contrarians. Right? We all know that. They're the ones who get into something which hasn't done well. And so it's the exact opposite of what should be done.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.